Do you know where the profits come from after investing in real estate? So the first thing that we're going to talk about is cash flow. Cash flow is most impacted by the rental rates. So you buy a property, you rent it out, and depending on how much you get for that particular unit, you will be receiving a cash flow. And as we can see in this chart, you are always seeing an uptrend on the rental market. In fact, it's about a 3 to 4% everywhere, and it's not a straight line. You also have up and downs, but the downs are very short. And it might be that at some point they're actually coming down. However, since you have a year lease, that will not affect you, because at the end of the lease, when you are about to renew, guess what? Rents have actually gone up. And the worst that could happen is that you leave it the same for another year. In that way, you will still be making money. So now let's talk about the expenses that a property may have. The most common ones are property taxes, insurance, and then of course the ones that do not happen every month is maintenance, that every once in a while things will go bad, and the other thing is vacancies, when you're changing one tenant for another. So then you have your income, you subtract all your expenses, and that will be your net income. So in this particular example, I want you to see that you have a mortgage payment. It is okay to pay cash for a property because you don't have that commitment to the bank in case that the property is not rented. And I totally understand that. However, in this case, you are borrowing some money, you create a commitment to the bank, and as long as you have the money, you pay them, and in addition to all the expenses, you're still making a 6.2% on the investment that you made originally, which is not bad considering that you're getting the appreciation of the whole asset. In other words, you're making 6.2% on $100,000, which is the investment. However, you are making an appreciation, and we're going to talk about it in the next section, about the whole property. So $500,000 is your base for the appreciation that you will be getting. If you want to know a little bit more about this and other investment series videos, just go to my channel, subscribe to it, and you will see how the whole system works and how you can make sense out of financing every single property and not paying 100% cash. Lastly, I want to give you some notes on the cash flow. The first thing is that, as we already saw, rental rates always increase, and the worst that it could happen might be that you do not increase from one year to the next. The other thing is that once you have the reserves completed, meaning that you already have accounted for anything that could happen in the property, and that usually is achieved when the tenant stays for a long time, that amount of money would no longer be necessary to save. Therefore, you can disperse that as part of your return. And then, of course, that's only achieved when you have stable tenants. So going back to our original equation, we had that the total return was the cash flow plus the appreciation. So let's dive in on what appreciation can do for you and where it actually comes. Well, it happens that appreciation, there's two big sides of it. It is the appreciation of the natural market, and we are in Miami. I could tell you that the natural appreciation in Miami has been pretty high historically, higher than that of the United States. Therefore, it is a good place to invest. But the other appreciation is the forced appreciation, are the things that you can do, the way that you acquire property in order to be able to acquire it already with some equity. And let's dive in and see what has happened to natural appreciation throughout the years. So in this chart, you may see the natural appreciation, and this is from the 60s all the way to today. And you can see that despite of rising interest rates, high unemployment, oil prices, and different aspects of the macro economy, all the time values have gone up. And the main reason is because property are worth more and money is worth less. So historically, real estate always goes up. If you take just 7 years in average, it will always go up. The only time the property values have actually come down dramatically has been in the mortgage crisis. And that is a total different aspect of what happened in real estate, and that is a particular case. I do not think that with the type of mortgages that we have right now, we will ever get to that particular moment. So let's keep on finding out how that affects us and how we can benefit from the market appreciation. So let's talk about forced appreciation. Forced appreciation are the things that you can do to a property to increase its value. The first thing is buying them at a discount. Distressed properties are really good for that. You can buy properties from inheritance. You can buy properties from divorced couple or people that have been able to pay the property. And that is unfortunate, but we come as a savior because we can actually do a very quick transaction and save their credits or solve their problem. In addition to that, properties that have not been updated in a while, like a kitchen that hasn't been remodeled in 50, 60 years, or bathrooms and so forth. Those are the opportunities that we get to see. Before, properties used to have a big living area, and in those living areas, perhaps we may build an additional bathroom, an additional bedroom, and that will increase the value. And then, of course, we could probably rent it for more. Those are the things that we actually look for. And then the last thing, you can change the zoning or the use, which take a long time, but once you do it, you can really cash in those forced appreciation items. Some notes on appreciation. The first thing is that when you get appreciation on a property, that particular appreciation is there until you refinance or sell the asset. That's the only way that you can obtain that gain. Keep in mind that in Miami, every 4 years, 3.5 to 5 years, depending on the market, you can refinance and reap the rewards. And that is what we advise to do. In addition to that, you also can depreciate, which is a huge tax benefit because most of the repairs, improvements, capital improvements that you've done to the property are deductible in your taxes. And of course, the last benefit is that if you want to buy a bigger property, perhaps one that makes more money, you can actually sell that property through a 1031 exchange where you defer all your capital gain taxes. And that is how you go and grow that real estate investment as a snowball, because every time you sell, you go for a bigger property and you include all the benefits of that particular unit into a bigger and better one. So now how are we going to put all this together? Well, we're going to put it in a very simple terms. 6.2% was my benefit in cash flow. It is the money that I received every month. In addition to that, I got $40,000 forced appreciation after I did all the repairs, updates, and everything. And that is net appreciation. We put about $50,000 in this property, increased its value about 90, so that's a net of $40,000. And in addition to that, we have a market appreciation of 7.9 on the $500,000. That equates to $39,500. That's a total, including the pay down of my mortgage, of almost more than $90,000. That means I almost doubled my investment in only 1 year. This is the beauty of real estate, and we definitely want to be your real estate resource of choice. Give me a call or send anyone in my team a message. We will be able to help you at valenciateam@kw.com, as we want to make sure that you invest in the right place, with the right people, with the right knowledge, making sure that you do it safely, minimizing risk, and definitely increasing your returns. And remember, as I always end up all my videos, do not wait to buy real estate. Buy real estate and wait.